Times are tough for investors trying to offload units and apartments here in Melbourne.
It's just really difficult. It's an intense competition.
It's a social issue if young people can't afford to buy houses, but it's also a very significant economic issue.
Any metric, it's more expensive now when you compare wages to the cost of borrowing.
As an individual and as a citizen, I think we're in a very difficult position with the property market.
Melbourne home prices have been falling for 6 months straight, and a growing number of property owners are now selling at a loss.
We're told apartment living is the future, but who'd take the risk?
A developer in South Bank reviews the spreadsheet one more time. $800,000 per unit was the pre-sale price 3 years ago when construction permits were issued. Today, comparable units in the same building are listed at $650,000 and still nobody is buying. The building completed 6 months ago. 73 apartments remain unsold. The construction loan interest compounds daily at 8.2%. The bank sends emails requesting updated cash flow projections every week. This is happening across Melbourne right now. According to research published by Charter Keck Kramer in late 2024, approximately 8,000 completed apartments across metropolitan Melbourne remain unsold. These are finished, ready to occupy units sitting empty while developers hemorrhage carrying costs. This represents 17% of all apartments completed between 2020 and 2024, a figure unprecedented in Melbourne's modern development history. These apartments are concentrated in specific locations: 622 unsold units in the CBD, 676 in South Bank, 597 in Footscray, and 504 in Box Hill. But the unsold inventory extends into suburbs the Victorian government designated as future growth centres under its activity centre proposal, including South Yarra with 161 unsold units, Coburg with 183, and Brunswick with 113. This represents far more than a developer liquidity problem. When nearly 1 in 5 completed apartments cannot find buyers at any price point, the implications cascade through construction employment, bank mortgage books, superannuation fund property holdings, and the viability of the state government's ambitious housing supply targets. Understanding the mechanism driving this market failure matters whether you hold Australian bank shares, own property in Melbourne, or work in construction-related industries. If this kind of detailed market analysis is valuable to you, joining the channel helps us continue investigating housing trends, developer economics, and construction sector dynamics that mainstream media overlooks. The cash flow trap developers operate on borrowed capital. When apartment projects are conceived, developers secure construction loans based on pre-sale commitments. Banks typically require 70–80% of units pre-sold before releasing construction funding. This worked reliably for decades in Melbourne's apartment market. The current crisis emerged because projects pre-sold between 2019 and 2021 were delivered into completely different market conditions than existed when sales contracts were signed. Apartments pre-sold in 2020 were purchased by investors at $8,000 to $10,000 per square meter. These buyers committed based on rental yield projections and capital appreciation expectations that made sense in a low interest rate environment. Many were foreign investors from China, Malaysia, and Singapore, attracted by Melbourne's reputation, education institutions, and lifestyle. Then conditions shifted. Interest rates increased from 0.1% in May 2022 to 4.35% by November 2023. Foreign investor taxes and charges, implemented progressively since 2017 and intensified in 2022, added substantial costs to offshore buyers. Melbourne endured extended COVID lockdowns that damaged the city's international reputation precisely when these apartments were being delivered. Construction completed. Buyers who had signed contracts years earlier faced settlement. But mortgage serviceability requirements had changed dramatically. Banks that pre-approved loans in 2020 reassessed serviceability at 2023 interest rates. Many pre-sale buyers could settle. Developers faced a choice: pursue legal action to enforce contracts, knowing buyers lacked financing and judgments would be uncollectible, or release buyers from contracts and attempt to resell completed units into a market already saturated with distressed inventory. Most chose the latter. The alternative meant litigation costs, further delays, and zero cash recovery. But reselling presents its own mathematical problem. New apartments entering the market in 2025 require pricing at $12,500 to $15,000 per square meter to cover current construction costs, which have increased 76% since 2015. Build costs alone jumped 78%. Open space contributions surged 187%. Consultant fees rose 161%. Land costs increased 53%. Developers holding completed inventory from the 2020-2021 cycle face impossible competition. They cannot price at $12,500 per square meter because their units were built at $8,000 to $10,000 per square meter cost structures, and buyers compare them to newer stock. But pricing at $8,000 to $10,000 positions their completed units as discount alternatives to new developments, which depresses new project viability. Here is where the numbers become uncomfortable. Every unsold apartment generates negative cash flow for developers. Construction loans do become interest-free upon completion. Interest accrues at commercial rates, typically 7 to 9% annually on the outstanding loan balance. A $600,000 apartment financed at 8% costs the developer $48,000 annually in interest alone, plus strata levies, utilities for display purposes, and opportunity cost of tied-up capital. For 8,000 unsold apartments with an estimated aggregate value of $5 billion, annual carrying costs exceed $400 million. This capital drain prevents developers from launching new projects because banks require developers to demonstrate existing project profitability before extending credit for new ventures. The construction industry pressure. The apartment oversupply intersects with broader construction industry distress. According to Australian Securities and Investments Commission data, construction company insolvencies reached unprecedented levels between 2022 and 2024. In 2022, 1,793 construction firms entered external administration. In 2023, that figure jumped to 2,546, a 42% increase. In 2024, 3,217 construction firms collapsed or entered administration, another 26% rise. Victoria has been a focal point, with Melbourne-based companies accounting for a disproportionate share of failures. High-profile collapses illustrate the mechanism. Porter Davis Homes, one of Victoria's largest residential builders, entered administration in March 2023 with over 1,700 homes under construction. Roberts Co's Victorian arm collapsed in March 2025, leaving 8 major projects abandoned, including Australia's largest Amazon warehouse. The company recorded losses exceeding $60 million, with the Craigieburn Amazon project alone losing $56.1 million. Project Coordination, a Canberra-based builder operating for over 50 years, collapsed in April 2024, owing more than $25 million. Grocon, responsible for iconic Melbourne developments including Eureka Tower, entered liquidation in May 2021 after complex financial disputes and project delays. The common thread: fixed-price contracts entered during the housing surge collided with post-COVID input cost inflation. Builders committed to deliver projects at 2020 prices using 2023-2024 materials and labor costs. The mathematics became unsustainable. This relates directly to the apartment oversupply. When construction companies collapse mid-project, incomplete developments tie up capital, damage lender confidence, and create market uncertainty. When completed projects cannot sell, construction companies lose their primary revenue source: progress payments from new projects. According to statements from Mirvac's chief executive of development, Stuart Penklis, at Citi's investment conference in late 2024, major subcontractors were flagging significant workbook drop-offs for 2025. Government infrastructure projects were completing without equivalent private sector apartment projects commencing. Crews were already laying off staff. When subcontractors reduce capacity, remaining active developers face higher costs and longer timelines for new projects. This further increases the break-even selling price for new apartments, widening the gap between new stock and unsold legacy inventory. The foreign investment withdrawal. Melbourne's apartment boom was substantially driven by foreign investment, particularly from Chinese buyers. According to property industry research, foreign investors were attracted to what analysts termed Brand Melbourne, the city's livability rankings, education institutions, cultural amenities, and stable governance. Since 2017, and increasingly since 2022, the Victorian and federal governments implemented progressively higher taxes and charges on foreign apartment buyers. These measures were designed to cool housing speculation and prioritize domestic purchasers. The policy achieved its intended effect, but created unintended consequences for apartment supply. Foreign buyers withdrew from the market precisely as developments pre-sold to them were completing. Those who had committed in 2019-2020 faced much higher settlement costs due to accumulated tax changes, interest rate increases, and unfavorable currency movements. The Australian dollar depreciated significantly against several Asian currencies between pre-sale and settlement dates. A Chinese buyer who committed AUD $800,000 in 2020 faced substantially higher yuan-denominated costs at 2023-2024 settlement, compounded by Australian foreign buyer surcharges and restrictions on capital outflows from China. Many chose to forfeit deposits rather than complete settlements. Developers retained deposits, typically 10% of purchase price, but faced the larger problem of reselling units in a market where the buyer demographic that had previously absorbed new supply had been systematically discouraged from participation. Richard Temlett, Charter Keck Kramer's National Executive Director of Research, explained that Melbourne differed from Sydney in apartment buyer composition. Sydney maintained a higher proportion of owner-occupier buyers. Melbourne's apartment market skewed heavily toward investor-grade buildings, and substantial inventory was designed specifically for investor rather than owner-occupier preferences. When investor demand evaporated due to tax changes, interest rate increases, and rental yield compression, no alternative buyer demographic existed at sufficient scale to absorb supply. From June 2021 to June 2022, the City of Melbourne local government area introduced temporary stamp duty concessions on unsold completed apartments. The incentive generated strong uptake. Once removed, demand dropped significantly, demonstrating that price sensitivity was extreme, and targeted government intervention could move inventory, but only with substantial financial concessions. The price corridor problem. The unsold apartment inventory creates what economists term a price corridor problem. New apartment projects cannot proceed unless selling prices reach $12,500 to $15,000 per square meter to cover 2025 construction costs. But 8,000 completed apartments are available at $8,000 to $10,000 per square meter. Buyers conducting rational price discovery will purchase completed, immediately available inventory at $10,000 per square meter, rather than commit to off-the-plan purchases at $15,000 per square meter, even if the newer project offers marginally better amenities or location. This creates a feedback loop. Unsold legacy inventory suppresses new project viability, which reduces construction activity, which eliminates jobs, which weakens buyer confidence and purchasing power, which further depresses demand for both existing and new apartment stock. The Victorian government established a target of 800,000 new homes over 10 years, requiring 80,000 annual completions. Meeting this target depends heavily on apartment construction in designated activity centers, many of which currently hold substantial unsold inventory. Box Hill, designated for a suburban rail loop station and earmarked for accelerated development, has 504 unsold new apartments. How do developers justify launching additional projects when existing completed inventory cannot find buyers? Footscray, another major activity center, has 597 unsold units. South Yarra has 161. These are precisely the locations where density increases and apartment construction were supposed to deliver housing supply targets. Some analysts argue the government should purchase unsold inventory for social and affordable housing. The arithmetic appears favorable. Apartments available at $8,000 to $10,000 per square meter represent significant discounts to current construction costs. Government purchase would clear developer debt, restore construction sector confidence, house key workers in rental-stressed markets, and remove competitive overhang preventing new supply. However, acquiring 8,000 apartments at an average cost of $650,000 per unit requires $5.2 billion in capital. The Victorian government's fiscal position, strained by infrastructure commitments including the suburban rail loop, makes such intervention unlikely without federal support. The suburban rail loop itself creates additional pressure. The project requires $11.5 billion in funding for its first stage, which the state budget indicates will come from value capture levies on approximately 70,000 apartments expected along the corridor. That equates to roughly $165,000 per unit in additional costs, further increasing the selling price required for new apartment viability. What happens if this continues? If unsold inventory remains on developer books while construction costs continue rising, several outcomes become probable. First, developer insolvencies will accelerate. Firms carrying $50 million to $200 million in unsold inventory cannot service debt indefinitely while generating zero revenue. Banks will foreclose on construction loans, forcing asset sales at distressed prices. This will further depress market valuations and create contagion effects as distressed sales establish new price benchmarks. Second, construction sector employment will contract significantly. According to industry sources, major subcontractors were already flagging workbook declines for 2025. If apartment projects do launch because pre-sales remain unachievable, subcontractors will reduce permanent staff and apprenticeships. Victoria's construction sector employs hundreds of thousands directly and indirectly. Sustained contraction propagates through related industries: materials suppliers, transport, professional services, and property services. Third, rental supply will tighten further despite physical oversupply of completed units. This appears paradoxical but reflects ownership structures. Developers cannot rent units they are attempting to sell because showing rented apartments to prospective buyers is difficult and reduces sales appeal. Some developers rent units temporarily while awaiting market improvement, but most keep units vacant to maintain sales optionality. Melbourne's rental vacancy rate stood at 1.3% in May 2024, well below the longer-term average of 2.6%. Median weekly rents increased 4.8% over the prior year and 16.4% on average over 3 years. If 8,000 completed apartments remain off the rental market while construction of new supply stalls, rental affordability will deteriorate despite physical housing surplus. Fourth, apartment quality standards may decline. Developers facing extreme financial pressure have incentive to reduce construction costs through specification compromises. Australia already faces significant building defect problems in multi-unit developments. Financial stress increases the probability of corner cutting, which generates future liability exposure and degrades Melbourne's apartment stock quality. Fifth, bank exposure to developer loans and mortgage books will increase. Australian banks hold substantial construction loan portfolios and residential mortgage exposure. If apartment values decline 20–30% from recent peaks, some borrowers face negative equity. This constrains refinancing options and limits housing market liquidity. Banks may tighten lending standards further, creating credit availability problems for viable projects and creditworthy buyers. The institutional implications. Melbourne's apartment crisis signals broader challenges in Australian residential property markets. The fundamental issue is that construction costs have outpaced purchaser capacity across most asset classes and locations. Between 2015 and 2025, total development costs increased 76%, while revenues rose only 41%. This gap is mathematically unsustainable. Either costs must decrease or prices must increase substantially, which requires significant wage growth or credit expansion. Neither appears imminent. Wage growth remains below inflation in many sectors. Credit expansion faces headwinds from elevated interest rates and banking regulatory requirements. Construction input costs show no signs of meaningful deflation. This suggests apartment construction will remain depressed until either government intervention clears existing oversupply through bulk purchase programs or economic conditions shift dramatically. The latter could involve substantial interest rate cuts, wage growth acceleration, or inflation-driven nominal price increases that make existing debt burdens more manageable while increasing purchasing power. However, rate cuts face constraints. If inflation remains above the Reserve Bank's target band, rate reductions appear unlikely. Even if cuts occur, mortgage serviceability buffers mean rates would need to decline substantially before meaningfully improving buyer capacity. Some economists suggest the market requires a correction period where apartment values decline 20–30% to restore alignment between construction costs and achievable selling prices. This would devastate recent buyers and developers, but potentially clear the market for a new cycle based on realistic pricing. The risk is that correction severity destroys developer and lender confidence to the extent that recovery takes years rather than quarters, similar to patterns observed in markets like Ireland post-2008 or Spain post-2012, where apartment oversupply created decade-long adjustments. Melbourne's apartment situation also reveals tensions in housing policy. The Victorian government simultaneously pursues ambitious housing supply targets while implementing tax and regulatory changes that reduce investor participation and increase development costs. These policies work at cross purposes. Stamp duty concessions introduced in October 2024 for off-the-plan purchases represent recognition that developer economics require intervention, but temporary 12-month incentives create timing arbitrage rather than structural solutions. The uncomfortable question: 8,000 unsold apartments in a city experiencing a housing crisis represents market failure at systemic level. Physical supply exists. Demand exists, as evidenced by rental vacancy rates below long-term averages and continued population growth. Yet supply and demand cannot clear at any achievable price point. This suggests the problem extends beyond apartment market dynamics into fundamental questions about construction cost structures, taxation approaches, and the viability of current housing delivery models. If building apartments costs $12,500 to $15,000 per square meter, but buyers can afford only $8,000 to $10,000 per square meter, who bridges that gap? Developers cannot operate at sustained losses. Buyers cannot pay prices that exceed their borrowing capacity. Banks cannot lend beyond serviceability limits without assuming excessive risk. The traditional answer involves government intervention through planning changes that reduce land costs, tax concessions that improve project viability, or direct subsidy programs that bridge the affordability gap. Victoria has attempted elements of all three with limited success. This raises a larger question. If Melbourne, one of Australia's most successful and economically diverse cities, cannot sustain viable apartment construction under current settings, what does this indicate about housing supply solutions in other markets facing similar cost structures? The 8,000 unsold apartments are symptoms, possibly warnings. They demonstrate that housing markets can experience simultaneous oversupply and undersupply when price discovery mechanisms break down and construction economics become detached from end-user affordability. How this resolves will have implications extending far beyond Melbourne's property sector. Superannuation funds hold significant Australian residential property exposure. Banks have large mortgage books. Construction employs hundreds of thousands. Housing affordability affects migration patterns, consumer spending, and political stability. If this analysis provided value to you, joining the channel helps us continue delivering in-depth research on property markets, construction economics, and investment dynamics that mainstream outlets rarely cover. Your support allows us to keep producing this level of detailed market analysis.